Now, there is another point why this recession could be worse than anything we've seen in the past. It's again due to
Um,
inflation. The Federal Reserve cannot lower interest rates and start QE again as it did in previous recessions, because again, it's going to exacerbate the inflation. So the Fed is kind of trapped.
yeah, they're stuck between a rock and a hard place.
Yes, on one hand, if they lower interest rates, they're going to exacerbate the inflation. And if they try to fight inflation by raising interest rates, then they're going to exacerbate the recession. So they're going to be, as you say, stuck between a rock and a hard place. And I expect them eventually to be powerless to help. They're going to just sit idly by and watch as the consequences of their past mistakes come back to haunt them. They will be powerless to help. Well, first of all, we need to point out that topics such as, the bond market, it sounds kind of complicated, and people tend to shy away from such topics because it seems too complicated for them. But as a matter of fact, it's not very complicated. The only thing that people need to be aware of is that the yield curve is the best indicator that we have for a coming recession, and that when this strange phenomenon that the yield curve inverts, it simply means that long dated bonds have a lower yield than short-term bonds. It's not supposed to happen usually. In a normal market, bonds which have a longer maturity, have a longer duration, need to be traded for a higher yield in order to reflect the added risk which is involved with holding them. But every now and then, we have the historical data to show that it inverts, which means that the short-term bonds have a higher yield than the long-term bonds. And this is what happened again a couple of years ago. Now, you don't necessarily get a recession immediately. There's usually a time lag of up to 2 years. We had an inversion started a couple of years ago. It ended this September. Now, usually the recession, historically, the recession begins after the yield curve uninverts.
That's interesting. The data indicates that this inverted yield curve uninverting does predict a recession, and and of course it makes sense. As we can all imagine, if you're going to hold a longer yield bond, you would expect it to pay out better. And when you see this kind of not making sense, where the shorter yield bonds are better, that's something to watch out for, folks.
Now, the definition of a recession is 2 consecutive quarters of negative GDP growth. So, as a matter of fact, we will only know at the end of the first quarter of 2025 whether or not we are currently in a recession.
Right, gotcha. Yes.
So, don't come to me in a month or two and tell me, Olin, you said that we're perhaps in a recession, but no recession has been declared. What are you talking about? Well, it's going to take a very, very long time for an official declaration to come out, but it doesn't change the fact that we could be in a recession as we speak right now. So, how shall we know if we're truly entering a financial crisis? Well, you'll hear on the news all sorts of bad things are happening. For instance, a stock market crash, or at least a stock market correction, or perhaps the failure of a large financial institution which suffered losses in the
Commercial real
bond
estate.
market or in the commercial real estate markets, which we know are not doing well.
No, commercial real estate is in really bad shape right now.
Or it could also come from the tech industry because there are rumors that certain large tech companies have been involved in, shenanigans. They've been vendor financing their clients. They've been loaning money to their clients so they can buy their product and this way jack up the stock price. And to me, it sounds a bit fishy. So that's a possible trigger for a recession. But what people need to keep in mind that the trigger itself is not that important. It's more of a media thing. Like it's like the excuse which the media gives for a recession. But the true cause of a recession is that the economy was over leveraged to begin with, and the Federal Reserve raised interest rates and led to all those bankruptcies, which we will eventually see. But right now, people can postpone such things. People can hide all sorts of things inside balance sheets. And it's only when they can't hide it any longer that you see the recession manifesting itself. And I want to say, I've been warning people for a very, very long time that what the Fed has done, what central banks in general have done, will lead to a huge, huge financial crisis. And I also argued that this financial crisis, the coming recession, will be much worse than anything we've seen in the past. And, for a long time, it did not materialize because this system has this ability to, just extend and pretend, as some people say. But there comes a point in which you can't hide the losses any longer. And I have a feeling that we're getting close to that point. And as I said, I have a few indicators to back it up.
Yeah, there's a saying that a lot of times people use for individuals who are trying to come up in the world, and they say, fake it till you make it. And, these people, pretend like they're doing better than they are. And to your point about, them hiding some stuff on the books, for example, with commercial real estate, they might have a building that was worth $200 million that's lost 25% of its value. So really it's down 50 million right now, but it's an unrealized loss because they haven't had to refinance that yet. Well, with the interest rates where they are right now, I mean, a lot of people are still paying higher interest, than they were 6 months ago if they want to buy a house. It wouldn't surprise me if a lot of these big buildings are going to end up in the same situation when they end up going to refinance these. They're still having to deal with these high interest rates. Maybe it's up a little, maybe it's down a little. I don't know for sure, but it's still going to be a burden considering a lot of these loans were written when we were very low to maybe even 0% interest rates. And so these guys, some of these, especially regional banks, um, they could be in some big trouble when it comes time for them to redo these loans. Um,
Now,
um,
the next indicator, which I wanted to discuss, because when I research these things, I want to see not only one indicator flashing red. I want to see multiple indicators. I want to see indicators confirming each other. And
right, and
another,
that's something that I think everybody really appreciates about you. Because so when you looked at the yield curve, you see that that is indicating a recession. And so when you're looking at the unemployment data, I'm not sure if that's the one you were going to bring up next.
yeah,
Um,
the
what is
unemployment
that
data.
telling you about a potential recession?
Unemployment, the rate of unemployment is, of course, a lagging indicator. So you expect to see a dramatic increase in unemployment only once a recession has been officially declared. But we know that during times of growth, unemployment tends to decline gradually, very gradually, and it never increases in a sustained fashion except right before a recession. If we look at the historical chart,
That is
and
interesting.
and the thing is that although unemployment in the US right now is still very low, it has been inching upward for quite a while. And it kind of looks like previous periods right before a recession when unemployment started to inch up. And I think we are again in such a situation. And this is why I'm so concerned. This is what we call the big one.
So that's already two indicators that a recession could start. And then there's a third indicator that you had mentioned in your video. And folks, please, when you get a chance, check out the video. I'm going to leave a link to it in the description. But it looks like every time since the 1980s that the Fed has cut rates, a recession has followed. and the Fed just started cutting rates recently. So that's a little concerning as well.
Yes. The Fed has this mode of operation. Whenever there's a recession, at least in the past 40 years or so, whenever there's a recession, they slash interest rates dramatically. And especially after 2008, they cut rates to zero, to the absolute zero, and they keep them there for quite a while. And then when things seem to settle down, then they start very gradually to raise interest rates. But usually, when you see the Federal Reserve ending its tightening cycle, there's usually a period in which they are constant, just like we've seen recently. But
Uh,
then when they start cutting interest rates, it's usually right before a recession.
so that's concerning. We did a 50 basis point cut, then another 25-point cut.
Yes.
And, it sounds like they'll probably be doing some more coming up here in 2025. But all signs point to, so that's three different indicators that he points out in this video, all pointing to that a recession could be coming.
Yes.
And
Now
it is
they
concerning.
could be telling us, oh, it's just a mid-course correction, and they still think the economy is doing well, and they're just cutting rates because inflation has been defeated, for instance. But historically speaking, the Fed usually doesn't cut rates when everything is fine. When the Federal Reserve cut rates, it's because they see trouble in the horizon. And there's a reason why they start cutting rates. And I'm afraid that that's yet another indicator that something very negative is brewing, underneath the ground.
Well, that is concerning. So all signs are pointing to yes, as far as an incoming recession, folks. And unfortunately, not to put words in your mouth, but it sounds like you're concerned that this could be worse than 2008. So everyone just keep that in mind. It might be a good time to kind of get your house in order, so to speak.
Uh, let's talk about the debt for a minute. The problem with debt is that you need to pay interest on it. And when the interest was very low, after 2009, for years we've had very low interest rates. So the debt wasn't as painful as it is today. But when you get inflation and you need to fight that inflation and you need to raise rates, and suddenly the interest payments on the debt start growing, start exploding higher. And this is exactly what happened in the past few years. We've seen interest payments on the national debt surpass $1 trillion. They are now the third largest line item in the budget after Social Security and health. And they surpass even what the United States spends on defense, which is quite amazing.
That's
And
crazy.
and this could lead to what we call a debt spiral. If there is a recession and the federal government wants to bail out the economy, then they need to spend more. And by the way, during a recession, tax revenues tend to fall off a cliff. So you get falling revenues, exploding spending. So the debt is going to grow. The interest payments are going to grow even further, and there's not going to be any way to pay them except taking on more debt in order to pay the interest. So it means the interest grows even further. It's like a debt spiral. One enforces the other. And there are some people who are assuming that rates are going to fall back to zero because we're going to be in a recession. They expect it to happen just as it has been in previous recessions. But hey, now we have inflation. And since we do have inflation, and I don't expect that inflation to disappear, I don't expect inflation to disappear even during a recession. I expect us to have what we call stagflation, both a recession and inflation at the same time, just like we've seen during the 1970s. And that means that you have to compensate the people who are buying your debt, you have to compensate them for inflation. So I don't think long-term interest rates can fall back to zero. They may decline for a while, especially if people panic and they pile into 10-year treasuries once again to protect themselves from the stock market declines. It could happen for a while, but long term, if inflation continues to be a problem, then rates can't fall back to zero. They can't stay this low. They need to grow in order to compensate people for that inflation, to give people a real rate of interest. And that means the debt could spiral out of control. This is what I'm concerned about. And now there is another point why this recession could be worse than anything we've seen in the past. It's again due to inflation. The Federal Reserve cannot lower interest rates and start QE again as it did in previous recessions because again it's going to exacerbate the inflation. So the Fed is kind of trapped.
Yeah, they're stuck between a rock and a hard place.
Yes, on one hand, if they lower interest rates, they're going to exacerbate the inflation. And if they try to fight inflation by raising interest rates, then they're going to exacerbate the recession. So they're going to be, as you say, stuck between a rock and a hard place. And I expect them eventually to be powerless to help. They're going to just sit idly by and watch as the consequences of their past mistakes come back to haunt them. They will be powerless to help. So I think we're going to end up in a situation in which neither the Federal Reserve nor the federal government can come to the rescue, not through monetary policy and not through fiscal policy. Both avenues are going to be blocked. And as a result, we're going to have to, suffer a recession without anyone coming to help us, as a public, which is suffering from high unemployment and rising prices at the same time. Thank you for listening to the Silver Hermit podcast. If you like this content, please donate in the link which appears in the description below. Please subscribe to this channel and share it with your friends and family. Hit the bell icon to be notified whenever I release a new video. Remember, I'm not a licensed financial advisor. This video is intended for general informational purposes only and should not be regarded as investment advice. Before taking any investment decision, please consult with a professional financial advisor who may assess your personal investment objectives and needs.